Welcome, welcome, welcome. This will be lesson 1 of the Forexia Pro Education Pack. Today we'll be talking about mainstream technical analysis, going over using TradingView.com. TradingView will be our main platform in which we graph our currencies. We're going over mainstream technical analysis using trend lines, support and resistance, how to draw trend lines and support and resistance. We're going over how retail traders think and act, and how support and resistance and trend lines create mental barriers. We're going to also go over common patterns such as wedges and how wedges should be traded and how retail traders normally trade wedges and breakouts. So, first off, we're going to be looking at drawing trend lines. We've all heard when trading that you should always go with the trend, right? And trends are a very common aspect across all markets and all currency pairs. And also on all different time frames, you'll find different trends. Like on the 4-hour chart, it looks here like gold could be somewhat in an uptrend right here, but then you go to a bigger picture like a daily, and it looks like it could be on a bigger downtrend. But the bigger the time frame, the more time you will be expecting to wait for the trade to play out. But it will be much more profitable trade. But it will also take much longer. And many people that swing trade or day trade, or I should say, swing trade, macro trade over long periods of time, use the higher time frames. So, I guess before we should get into drawing support and resistance and trend lines, I should go over how to use TradingView. Basically, TradingView it's very simple interface. Here is your currency pairs. You type in whatever you want, USD, CAD, that's the US dollar versus the Canadian dollar. Wow, I drew this out about 70 days ago, and it went into 500 pips profit. That's just some of the perks you guys will be learning in the lessons to come, catching amazing trades like that. So, we can see here is what we talked about. You can go find different currencies, Euro USD for example. Up here we have the time frames. So the time interview, time interval, like we talked about. The hour, the 15-minute, the daily. For me, my favorite, as you can see, is the 15-minute. I like to use the 15-minute chart to enter and exit. I also like to spot different patterns on the 15-minute chart. And my second favorite is the 4-hour and the 1-hour. The 4-hour I like because Oh wow. Let's get rid of this stuff. Okay, the 4 hour I like because you can see the trend a little bit better. And when I'm trading the 15-minute chart, I'm not just going for 10, 12, 15, 20 pips. I'm going for 30 to 50 to 100 plus pips, trying to get the entire trend as it moves on that 15-minute time frame. So you can see this movement on Euro, this entire movement here could have been caught on the 15-minute chart, and that's 150 pips. But it's all how you look at it. Just for me, the 15-minute chart is it's just easier for me to find patterns. But it's just a preference. You can use any time frame you want. We'll go into, in future lessons, we'll talk about trading M's and W's and how they form. And we'll be focusing more on the 15-minute chart than anything. But for now, you can do, use whatever you feel comfortable with, whatever you like. Here we have the next is the different types of candles, how you like to configure your chart. I know some people like to use lines, which, that's almost the same thing. I prefer the candles. There's also the Heiken Ashi. There's a lot of different crazy types. But we're going to be focusing on just the candles for right now. And then the indicators, I mean, they're really not useful at all. I really don't use them that much. I have one on right now, the TDI. I also have, I usually use TDI and EMAs, but we'll get into that in future lessons. These other small, this is to create an alert, if you want to alert yourself when price is at a certain point. But yeah, we're not going to focus on any more stuff here. We're going to be focusing on this. Okay, this is our trendline tool. This we use to see the direction of our trend. And for our goal or our purpose, we're going to be using a better time frame. So let's choose right here. This is a great example of an uptrend that broke its trend line right here, the support, whatever you want to call it. It broke out there and then continued. But you can see, if we graph this trend line, there is a clear indication of price respecting this zone that comes up here and this zone that comes parallel to that zone. So price is moving in between here and respecting these two parallel bars. And this is this very movement here of respecting these areas of whatever you want to call it, support and resistance or channels. This movement creates the basis of technical analysis. The entire system is built upon this movement right here. The following of trends, the ability to graph invisible lines on your chart that will apparently give you confidence in the future to trade some sort of pattern similar to this or a similar trend. But you're going to learn in future lessons that that is not the case. And we are only going over how to graph this type of technical analysis because we want to know how retail traders react and how they trade, how this system has been built to be manipulated. So this is our base system. We have to understand how the retail traders react to it to understand how it's being manipulated in the first place. So you can see we have graphed out our trend lines, right? Our trend lines are graphed out. Let's just say that this has not occurred yet. This spot right here has not occurred yet. So price is up to right here now. Let's just say. We can see it's going up. It's been bouncing up and down between these two lines. What would we do when price comes down here? And then, or I guess I should say, how can we spot support and resistance? So we just went over how trend lines work and how to graph them out. This was an example of a uptrend. Now we will start graphing our trend lines or our support and resistance lines with our trend lines. And this will give us kind of an example to see where price may bounce off of. But just remember, you guys, this lesson is not how I want you to set up your charts. This is just an example of how retail traders set up their charts. And you can set up your charts like this, but I do not recommend it. Because what I'm about to show you is that these lines will create a mental barrier in your head. And every time one of these lines is tested, your fear and greed, your emotions will start going and testing you more and more. So let's say price is right here. We're retail traders, okay? Let's say we are retail traders and we bought off of this. We bought off of this, basically that second leg of the W right there. But let's just say we bought off of the bounce of the trend line. We managed to buy right there. But what do we have here? We have 1, 2, 3, 4, 5. And we could probably keep going. But for right now, we have 5 support lines that price will need to break before even reaching where we are expecting it to reach. Because since price likes to follow a trend, and we know that, we would expect it to go down here, up here, down here, and then once again up. But since you have graphed out all these invisible lines and you're putting them wherever you want, that will create a mental barrier in your mind. And when price comes, okay, let's say price came up to right here. You are right here. You're all excited because you bought here. Price is right here. You're in profit. You're in a bunch of profit. But the next 4 hours comes, you see this big candle. There's a big rejection at your resistance line. That creates a barrier for you. That provokes your emotions, you guys. That is something that retail traders must understand. That's something that you guys have to understand, is that this is an invisible line. You put it there. It was never there in the first place, okay? Before you put it there, you gave it the meaning, okay? And whoever told you that it means something, whoever told you to use this system, gave you the illusion that this line on this chart means something to you. And that alone will hinder you from staying in this trade, okay? Let's say you stayed in that trade, but, okay, your emotions are going wild, okay? Your emotions are going wild. Finally, after, what, like 16 hours, price finally comes back up, and you're going crazy again. You're like, yes, I'm in profit. You see that double top here, price falls below your line again that it took 4 hours to break. Or I should say 16 hours to break. It fell below it again. You could see it retested it here. Your emotions were going, you're getting a bit more emotional, and then it came back up. And you started feeling more confident. And then what happens? It comes back below that invisible line. Your confidence is slowly depreciating. And then you close out your trade. And then what happens? What happens right after that? Straight green bars. How many pips was that? 600 pips. All the way to where you were expecting it to go. 676 pips. You could have bagged from right here, you could have gotten 850 pips. But you were scared out right here at 180, at 200 pips maybe, because of this invisible line. Something that if you didn't graph these out, they wouldn't even be there. Okay? It's things like this that we're taught, you guys. And we're taught this for a reason. We're taught to trade like this because trading is 90% mental and 10% skill and strategy. And in future lessons, we'll go over the very reason of this. We're going to be going over the structure of the market and how it literally provokes in you a sense of fear and a sense of disaster, or an emotional distraughty that really jolts your system. And that's why Forex is, and trading in general, is something that is 90% mental. And that's why many people don't understand. It's because there's a structure built in the market and how price moves. And once you connect an emotional stimuli to this, like money, you have connected your emotions to money, and then you run money through this loop, through this construct. Your emotions will be provoked in a certain way to get you out of that trade. So, now we've gone over support and resistance. let's talk a little bit more about technical analysis, trading with trend lines. Here again, we can see somewhat of a good trend. I mean, it's a great big uptrend. I'm sure that there's some people that are really good at technical analysis and that they do make a lot of money off of it. But you have to wonder, or you have to realize that these people have been trading for 10, 15 plus years, some of them, and just now they're making lots of money off of it. Why? Why did it take them 15 plus years, 10 plus years, sometimes 5, 10 plus years to get to where they're at? You know? And it's because they've been taught to trade in circles. They've been taught to trade the mainstream way. And there is a reason why 90% of people fail. And it's because we've been taught, we've been given the wrong tools, we've been taught the wrong way to trade. Every single one of these tools right here, every single one of these cipher patterns, Gartley, Elliott waves, every indicator here, it's all to blind you from every one of these candles. Because these candles, the movement, the structure is all you need. You don't need these trend lines, okay? You don't need them. You don't need support and resistance. You need to know the structure of the market and the highs and the lows and how the dealer works the highs and the lows of the days and the weeks and the months. But that is for future lessons. So, we're going to get back. I apologize for getting off course a little bit. That's just me. I do that all the time. But let's get back to trend lines. Here is a great example, I think. Yes. And I believe we talked about this. Here, I'm going to talk about how trend lines can be manipulated, how they're manipulated by the brokers, I mean the dealers, and how you can avoid this type of manipulation that we're going to talk about right now. So let's just say prices here, prices going up and down in this this range here, right? And we can see price bounced off right here. That was like our first, second, third, fourth, fifth, maybe sixth hit on the trend line. And apparently the more hits on a trend line or support and resistance line, the greater support or resistance that invisible line will have. Okay, that's what has been taught to many retail traders. The more hits to this line, or the more hits on a higher time frame, gives it a better deal of support. But I'm going to show you right here that that is not the case. If you were to sell right here, based on that terminology, that, you know, just because it it's been hit a lot, you know, and it was hit here again. You sold. Does that really mean that price is going to go and reach down there again? No. Many people were trading this on a 4-hour time frame, because you can see on a 4-hour and a daily time frame, because this would show up. This would only show up on a 4-hour and a larger time frame. This trend. So you can see when price hit here, many traders, many people were selling on a higher time frame, targeting this area, going for, you know, this 5-to-1 risk ratio, 500 pip drop, and maybe 100 pip stop loss. But what happened here? What happened is, you can see the dealer came down, showed the retail trader's profit on the higher time frame. Now remember, this is the higher time frame. Okay, on 15-minute chart, we would see totally different patterns. So we're on a higher time frame, we're thinking in a higher in a larger time frame. We're literally thinking in a more expanded time frame. So we would expect these traders that sold here not to get out of the market until prices about down here, where they expect the price to move according to this trend, you know, the downtrending market. But you can see that is not the case. What did the dealer do? He showed them profit, and you can see the dealer consolidated here for a bit, and it was as if he was consolidating there for a reason. He consolidated right here to get as many people as he could to sell. He got as many people as he could, as many retail traders as he could, to see this trend line right here, to graph this and see that, oh, look at that. There was a hit to that trend line, and it looks like the market, the Euro USD, will fall at least below this lower low, because that's what we know is a downtrending market, right? A market that creates lower highs and lower lows. And that's exactly what we have right here. We have that lower high, and then here is that low, and we would expect as a retail trader to get a lower low. Retail traders are showing profit. Then market consolidates for a few days, lets retail traders sell, then closes out the week right here under that trend, under that trend line in the main trend, right? What happens then? The market maker, the dealer, then gaps up 200 pips, I believe, and jumps a lot of stop losses here. And just in case you thought that the market was going to go back down, because you've waited all the way over the weekend and you were so pumped to trade, your emotions, you're totally not even going to see that the market has now created a higher high here and is shifting its trend. So most of the retail traders stay in their positions that sold here and slowly get dragged out of the market and have their stop losses hit. Or if they move their stop losses below their entry price that was here, they move their stop losses to, let's say this line here, their stop loss was jumped by the gap. And in future lessons, we'll go over the gap and how it works. But just know that the dealer can use the gap, the opening of Sunday into Monday, to literally jump price from one price to another and shift entire zones just like that without even using a bar, and leaving the liquidity that's in between this area untouched. So, what have we not gone over? We have not gone over wedges yet. And I guess breakouts. So, there's a lot of traders that trade just because of bars and certain bars and certain breakouts. Here is a perfect example. We can see price came up, and let's say you are just using support and resistance here. Let's say this is your resistance line. You have a few of those. Got one right there, whatever. You got it here, and all up in there, right? So, price comes up, consolidates here for a bit, and you draw your resistance right there. And since you're a retail trader and you are taught to trade breakouts of support and resistance, you bought the breakout of this resistance. You bought right here. Probably one of the worst possible places, but that's what you were taught, and that's what you believe in because of YouTube, and because some dude on YouTube told you how to trade a breakout, and he made, 50 bucks off of it last time. So, what happens then? Market breaks out how many pips? 50, 60 pips? Not even. 23 pips to the upside. You're maybe 5, 10 pips in profit, and then the market closes on you. Again, the dealer gaps here. He gapped all the way down here on you. Okay? If you held your trade over the weekend, the dealer gapped 70 pips. You would have went into about 72 pips or so of drawdown before seeing any profit again. And I doubt you would have held your trade over the period of 2 or 3 days. And even if you did, you saw this news, you could have stayed in, maybe gotten 150 pips, but right away again. This was another one, just to catch those breakout traders. Look at this big railroad track. That's what we call these candle formations, where one candle shoots up and then the next one straight down to follow it. It looks like a railroad track, a set of railroad tracks, right? So there it is again. You can see if you graphed the support above here now, and you had your pending orders right here, your buy limits, your buy stops all up in there, right? Right above this support. You think it's a break in the support, price will move up now that it broke that support. I don't know how retail traders can believe this BS, because that's what it is. It's complete BS that you can trade breakouts after seeing This. Wick after wick after wick after wick after wick after wick after candle. Just breaking out. Fake breaking out. Testing your emotions. And then coming right back down below the line again. This is the worst possible place to buy, you guys. And yet, we're being enticed by these buy stops and breakout trades that many retail traders are taught to do and to use. That's what the entire market is based upon. So, let's try and find a wedge and how we would trade a wedge breakout and how many retail traders trade wedge breakouts. Okay. Here's a good example, somewhat. Not a perfect example, but it'll do. You may not even see it right now, but this to me looks somewhat like a wedge. It could totally not be, but it'll do. It has its breakout. So let's say, as a retail trader, you were taught to trade wedge breakouts, right? Let's say you traded this, you saw this wedge, you traded it as a sell, you saw this breakout, you got into the sell right here. You finally saw the breakout, but that happened really quick. The breakout happened really quick, so you got in about right here. You were in about 10 pips profit. You bounced around, 10 pips profit, and then an hour later, boom, you were shifted into minus 33 pips within the next hour. So we're taught as retail traders to trade these breakouts of these wedges, but yet you can clearly see that many times the dealer will create wedges like this just to break out one way as a fake out and then go the complete opposite way. So let's try and find another one for you guys, because that wasn't a great example, but it was okay. It was alright of an example. No, that's a pretty bad example. Okay, here's an okay one. This looks like somewhat of a wedge. It could be one of those up tracing wedges or whatever they're called, uptrending wedge. But yeah, you can see it in one 15-minute candle. It closed, and it closed outside of this wedge. That's the most important, is that the candle closes outside the wedge to confirm to the retail traders that the sell is legitimate. So, at this close, retail traders sold. They were instantly put into 15 minutes profit. Shifted into 15 minutes profit instantly. 3 candles later, they're at break even. Not sure if they should close the trade out or if it's just an extension of the move down. So the retail trader is not sure of what's going to happen. What does the dealer do? The dealer takes 2 massive bars and shifts the zone in 2 huge bars. Before the retail trader has any time to react and close out his trade or change the stop loss was already hit. Or worse, you lifted your stop loss because this big green bar made you emotional, and you lifted your stop loss just so that this next candle the dealer could ram it up you and, you know, take any and all profit away from you and shift you entirely into negative. So you can see that's exactly what happens. The dealer entices you with these wedges that you see so clearly as a retail trader. The breakout is perfect. When you see something that's perfect, you have to turn around and say, yo, how many people are actually selling this breakout? Am I being trapped? Is this a trap? You got to put the brakes on and say, this could be a trap. Okay? And that's exactly what happened. That was a trap, and the dealer shot up about 100 plus pips. So that was lesson 1. I hope you guys enjoyed. If you did, take the time now to go over it again and do your homework. Just do as much homework as you can and see how the market is being manipulated right in front of you. Okay, if you want to do me a favor, or do any of your friends a favor, and if you learned anything, just talk to your friends that use technical analysis and that are struggling with it and say, you know what, bro, I think we've been lied to. I honestly think this is a big, big lie. This is a big setup. And there's something behind the market that isn't supply and demand. There's something behind the market that's moving it that is not entirely what we're being told. So, with that being said, thank you guys for watching. Until the next lesson, have a great day. Peace out.